Chinese economy is meeting some challenges now, obviously. Growth has slowed. They've gotten away from a market-led growth model. It's more about the state-owned enterprises now, and it's still too much associated with real estate investment and things like that. You're seeing issues around commercial real estate there.
China's economy last year posted one of its worst economic performances in about 3 decades, as the world's second largest economy dealt with a failing property market and weak consumption.
China's yuan is at a 16-year low, and the country appears to be experiencing deflation. Economists say these are signs China could be facing an extended economic downturn.
Do you know that China is facing a spiraling debt crisis and a period of deflation that might end? In 45 years of economic growth and reform, there has been persistent deflation for a third straight month on a yearly basis, and consumer prices were the slowest since 2009. Grappling with the mounting debt crisis, so what is the reason behind the cracks in China's economy, and why is the economy crisis still deepening according to a new report by the National Institute for Finance and Development? China's official debt to GDP ratio climbed to a new record high in 2023. Despite the slow pace of borrowing reflecting the economy weakening growth, as you know, today China is the world's second largest economy, but it certainly wasn't like that. The People's Republic of China was founded in 1949 by a Marxist dictator called Mao Zedong. He modeled the country's economy on the communist policy of the Soviet Union. There was no private property and no market economy. Instead, skilled workers were allocated jobs and their wages were not dictated by supply and demand by the government. But do you know what else? This approach was not only a deflawed economic model, but it was made so much worse by how impoverished China was in 1950s. China entered a deep famine that lasted from 1959 until 1961. The current estimate says that about 30 million people died in just 2 years of this famine. Throughout his region, Mao was estimated to be responsible up to 80 million deaths. After he died in 1976, China had a new leader, Deng Xiaoping, 2 years later. He led China for 11 years and made sweeping economic reforms that kick-started the longest and most successful period of economic growth in human history. He started introducing special economic zones allocated to cities where market capitalism was allowed to thrive, and the first of these cities was Shenzhen, a city that today is one of the most powerful economies in the world, a global hub for trade, technology, and finance. However, by 2011, China passed Japan to become the second largest economy in the world, with a GDP of $7.5 trillion. By 2015, the World Bank reported that China had reduced the share of population living in poverty from 88% in 1981 to just 7%. Almost a billion people pulled out of extreme poverty in just 35 years. The progress that China has made is astonishing, but it's still a very deeply communist country, and comparing China's current economic crisis and how successful it was prior years ago, the question remains, how did China get to this point of deflation? There isn't a simple reason for this, but rather the compounding of policy decisions, unexpected spread of disease, market euphoria lies, and mistake the economy is beginning to look like those that made it hard for America to break out during the Great Depression back in 1930s. Despite China having not experienced a stock market crash, what China does have in common with historic America is a loss of confidence in the economy structures and its future for America. The crash destroyed confidence, but for China, the root of its problem lies in President for Life Xi Jinping's policies. Sadly, the prospect of improvement seems bleak. However, one of the major red flags in the undesirable conditions is the decline of bank lending, a key indicator of both business and consumer spending intentions. According to the People's Bank of China, PBOC, demands for bank credit in December went down by 16% compared to the previous year and nearly 20% below consensus expectations. This is particularly noteworthy considering Beijing's substantial investment in stimulus spending on infrastructure and the PBOC's efforts to boost liquidity by reducing interest rates and expanding the broad money supply by about 9.7%. Meanwhile, the most likely explanation for why Chinese people and businesses have failed to take advantage of the infrastructure spending and this easy credit is that they see little prospect of gain. The truth is the flame of hope has flickered. The belief that things will get better has dimmed living a bitter taste of doubt. According to Beijing's National Bureau of Statistics, the Consumer Confidence Index has plunged nearly 10% since last March, reaching a historic low even amidst the chaos of pandemic and the burden of unnecessary lockdowns. The spirit remains broken under Beijing's zero-COVID policies, but what about the businesses? Though there's been a faint uptick in the business confidence since late 2023, it still hangs in the shadow of history, a far cry from the vibrant economy of the early 2000s. Speaking of the lack of confidence, China is facing this weirdness of borrowing and spending mirror the struggles the United States endured during the Great Depression. Just like back then, the Reagan economist John Maynard Keynes shed light on this dilemma. He understood the gears of economy can only turn when consumer and businesses believe in a brighter tomorrow. John Maynard stressed that stimulus effort from the government or an influx of money from the central bank can only reignite the economy if there's enough faith in the future to fuel it. But here's the catch. If confidence is lacking, if people hesitate to borrow and spend, the stimulus becomes a fleeting boost after a brief glimmer of improvement. The economy risks slipping back into the sluggish growth or even decline. And here lies the crux. The same applies to monetary stimulus. No matter how much liquidity the central bank injects in, confidence flatters. Businesses and consumers won't seize the opportunity. John Maynard coined the liquidity trap, the concept where even an abundance of resource won't rescue an economy trapped by the chains of doubt. But here's the something you should know. Most of the blame of China's economic challenge does not fall on the crashing stock market on the shoulder of President Xi Jinping. His policies have woven a tapestry of turmoil marked by 4 pivotal missteps. First, in 2019 to 20, President Xi Jinping abruptly withdrew Beijing's long-standing support for residential property development. This decision triggered a collapse in the once thriving sector, causing property values to plummet, leaving a trail of devastation on household wealth. His second misjudgment, a lukewarm response to unfolding economic troubles from the initial sign of distress in 2021. Until just a few months ago, Beijing chose to downplay the situation, pretending that reality demanded from the authorities. Instead of offering the necessary support for financial markets, a vacuum of action persisted. This lack of support became a breeding ground for the problems of the property sector and the decay of household wealth. The repercussions seeped into every corner of China's financial system, exacerbating the economic woes and eroding the very confidence that sustains a nation. Xi Jinping's third contribution to the woes comes in the form of zero-COVID policy. This decision sentenced the Chinese economy to ensure lockdowns and quarantines for 18 months longer than the rest of the world. Take for instance, in 2021, China bounced back with a GDP growth of 8.4% still when COVID resurged. In 2022, Xi Jinping enforced the zero-COVID policy, a radical shutdown for the country. That drove economic growth back down to 3% again, supported heavily by increased investment spent. The zero-COVID policy did permanent damage to a lot of the provinces in China, with the lots of foreign companies shutting down their China-based operation and laying off workers. In 2020, the net exit of foreign invested enterprises were 63,000. And in 2021, the number of companies exiting net of new companies was 61,000. His ambitious goal, eradicating the virus, became a relentless pursuit, a dream that shackled China's economy and sowed seed of doubt. For over a year and a half of people found themselves trapped in uncertainty, unable to rely on steady income. Businesses in turn saw little reason to expand. As if the prolonged lockdowns weren't enough, President Xi's rhetoric during this time added fuel to the fire. He chastised private Chinese businesses, demanding the abundant profit pursuit to align with the Communist Party's agenda. This rhetoric, more than anything else, cast a shadow over the future of Chinese businesses. Honor bred wariness and reluctance to invest in hiring or expansion as uncertainty became the unwelcome companion of progress. And in hindsight, COVID was the least of China's worries. They were about to deal with one of the worst real estate collapses on the record. Like most housing collapses, the story began many years earlier. In this case, in mid-90s, China's economic reform had been pulling millions of people out of poverty and into the middle class, so demand for middle-income housing was picked up in a big way in 1994. China introduced a new model for property developers where they be able to sell apartments before they had been finished or even in some cases before the project had been begun. One of these property developers was a company called Evergrande, founded in 1996. Their model was to borrow money from lenders and receive prepayments from customers. They would then build the property, sell it to the customer, and use the proceeds to cover their debts. By 2021, they had 1,300 projects running across 208 Chinese cities, generating property revenue of $76 billion and making them the second largest property developer in China. But this also came with the consistently growing debts. In that year, their liabilities owed to Chinese banks and foreign investors reached $35 billion. The problem was that the property market in China was becoming a bubble. People had seen massive increases in home prices and apartment prices and were beginning to speculate on them going further. Xi Jinping didn't like this at all. In 2021, he decided to clamp down on developer borrowings. In essence, this change restricted property developers from rolling their previous debts into new debts. In other words, they had to sell assets or come up with cash to pay down their current debts. Evergrande started missing debt payments in late 2021, according to S&P Global, who declared them in default on 17th of December. Evergrande continued to sell assets through 2022 to meet its obligation, but eventually filed for bankruptcy on August 17, 2023. Evergrande is just one example of the broader shock that hits the property market in China. Since 2021, a total of 53 developers have collapsed. 34 of the 50 biggest non-state-owned developers have become insolvent, and the default rate for Chinese real estates US dollar bond is now over 50%. This is a severe and ongoing problem in China. The property market currently represents about 30% of Chinese economy and about 70% of household wealth. As property prices has declined, it has a major impact on the wealth of its people. But China's problem aren't just limited to property. According to Fortune, a total of $6.3 trillion has been wiped off the value of Chinese and Hong Kong stocks since their peak in 2021. Tokyo has now surpassed Shanghai as Asia's biggest equity market. However, an Oxford economic study reached a similar conclusion, estimated that 40% of GDP is being driven by investment double. That had the US problem with becoming overly dependent on government investment for economic growth is that it starts to hurt productivity with poor investments. The GDP return per Chinese one of additional that has been declined for years. In other words, China is driving its growth by borrowing money and making lots of investments till their excessive spending on these investments means they are investing in a lot of projects that won't make the country any money. Likewise, Bloomberg reported recently that a deflationary environment is forming in China. With the consumer price index falling for 3 straight months, it's being driven by weak demand at the household level. And the jobs market in China has also gotten a lot worse. Youth unemployment, which was 10 to 12% before COVID-19, ballooned to over 21% in the middle of 2023. It recently fallen to 14.9%, but only after China changed the way that it's defined what a student is in its calculation. So China's economy crisis might continue, especially if Xi and his colleagues, the Forbidden City, fail to wake up to need to change policy so that individual Chinese and businesses can recover confidence. Such a change may be a full-on hope, but it is sorely needed. Anyway, what do you think about all this? Let's hear your thoughts in the comment section and don't forget to subscribe. Thanks for watching.